Thanks for tuning in to our weekly investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll get started with our chart of the week here, which serves as history's guide for what next year might look like for the U.S. large cap market. We get this cycle composite from our friends at Ned Davis Research, and it equally weights all one-year cycles, four-year presidential cycles, and the intermediate term 10-year business cycle. Now, rather than focusing on levels, direction is more important in this chart. We can see that history's view for 2026 suggests that the bull market could continue for the first third of the year before hitting some corrective action and finishing the year with a rally from the fall correction low. So this is a good perspective that tells us that we might want to temper expectations for another year of double-digit returns if history is to be a guide. Now, that pattern from our chart of the week is heavily influenced by Fed and government spending policy. So this chart here in blue in the upper clip, it shows only the historical four-year presidential cycle for the stock market for each year. Now, the orange line in the second clip shows the pattern for fiscal and monetary policy in those presidential years that line up with the stock market. Now, note that in year two, on average, stimulus fades meaningfully, and that's tended to create a drag on market returns. Now, as we think about next year, the Fed does have an easing bias, and the One Big Beautiful Bill Act should inject some fiscal stimulus as well. So the typical weakness we would expect in the midterm election year might be offset by the policy mix. We'll have to track these policies carefully in the year ahead. Now, turning to market action, the uptrends remain well intact for domestic and international stocks, with leadership from those international shares. Commodities and bond prices have also been in uptrends, and the dollar continues to trend lower. We continue to give the stock market bull the benefit of the doubt here. Now, likely the most impactful development from last week was the Fed rate cut. They've now cut 175 basis points in total since summer of 2024. Interestingly, longer-term interest rates have not meaningfully followed the Fed rate lower. That's likely because the economy is holding up and could accelerate next year. Regardless, the cut was supported by a softening labor market, and in orange here, we're showing the unemployment rate, and we can see that it has in fact been trending higher. We can also look at unemployment claims, which we get weekly. Note that claims rebounded last week, moving higher towards the upper end of its range since 2022. But also note that unemployment claims have not broken out to the upside and therefore remain consistent with slowing but still positive economic growth. Also supporting the Fed rate decision, underlying inflation pressure is pretty neutral right now. Yes, goods prices have some upward inflation pressure from tariffs, but shelter prices are easing, and the labor market is not supportive of sustained high inflation. Now, in orange in this chart here in the second clip is Ned Davis Research's inflation timing model. It's supposed to call inflection points in the inflation rate, and we show inflation here in blue in the top clip. We can see that the current reading is relatively neutral for inflation, implying that the underlying inflation pressure is not yet strong. One development that does give us a hint of caution as we head into the next year, it's been about 2 years since market breadth really surged. And that gave us a strong signal that the bull market could be a strong one. This chart here looks specifically at the percent of US stocks trading above their respective 50-day average price. And we show that in the second clip in orange. Now, it's currently about 60%. And we'd like to get this reading around 90% to be confident that the bull market's going to persist throughout 2026. This isn't a must-have indicator, but it is certainly a nice-to-have confirmation. All right, so closing out this week, we started with our chart of the week that shows history's view of 2026, and it does suggest a mid-year correction that's bookended by strength on the front and back ends. Now, the degree to which fiscal and monetary policy remains accommodative will play a role in how strong those rallies and corrections might actually be next year. Now, the Fed cut rates last week, and that's for a total of 175 basis points in cuts. And that cut was supported by both neutral inflation pressure and a softening labor market. Now, we're keeping an eye on market breadth. For now, the uptrends in stocks, bonds, and commodities are intact, while the dollar downtrend has persisted. We would have a lot more confidence in 2026 that the bull market can persist throughout the year if 90% or greater of stocks do trade above those respective 50-day average prices. As always, that's what we have for you today, and I want to thank you for joining us and wish you a great week ahead.